Hello and welcome to our reporting season Investor Spotlight, your shortcut to the results that matter. I'm Andrew Gagan. Let's get to the detail. And Car Group has reported a 10% increase in net profit after tax, reaching $275 million for the financial year, driven by a lift in revenue to $1.18 billion. It's also reporting pro forma EBITDA of $641 million, which was a 56% increase in EBITDA margin from the previous year. Shareholders will see a final dividend of 41.5 cents a share, 40% frank, representing an 8% increase on the previous year. Looking ahead, management anticipating continued double-digit growth in both revenue and earnings across all regions in FY26. Retailer JB Hi-Fi is losing its chief executive. Terry Smart will retire on the 3rd of October, with current group COO Nick Wells set to succeed him. The news coming as the group reported a 5.4% growth in NPAT to $462.4 million, which was weighed down by a one-off payment to settle the ACCC case against the good guys in 2024. Sales rose 10% to $10.6 billion, while EBIT increased 7.3% to $694 million. It has declared a fully franked special dividend of $1 a share, which, combined with the final dividend, will return a total of $224 million to shareholders. Trading momentum is expected in the first month of FY26, with JB sales up 6.1%, supported by new product launches. Dexus Convenient Retail REIT has delivered on FY25 guidance, with funds from operations and distributions of 20.7 cents per security. Income growth was 2.9%, supported by increases in rent and an increase in occupancy to 99.9%. After-tax profit coming in at $39.4 million, up from $3.4 million in the prior year, reflecting property valuation gains. It's providing guidance for FY26 for full-year distributions of 20.9 cents per security, with a yield of 7.1%.
Sure. I mean, I think the key thing the market's probably looking at today, first and foremost, is a resumption of earnings growth in the stock. I mean, it's been a challenging few years for any A-REIT in the market due to continual rises in interest rate costs. And we think we're at the period now where that headwind is turning and may well prove to be a tailwind. And so the market can now associate the low risk characteristics of Dexus Convenience Retail REIT, which is 99.9% occupancy, 95% of our rent roll to major national and international brands, a really long weighted average lease term of 7.9 years. They can associate those low risk characteristics now with both earnings growth, as you mentioned, 20.9 cents we're guiding to in FY26, but also growth in net tangible assets. So underlying asset base is growing, and we posted 2.2% growth in FY25, which I think the market is expecting more of.
Let's turn to the broker moves, and Bell Potter lowering its target price for QBE Insurance by 20 cents to $2.40 a share after the insurer posted its first half results. The broker maintaining a hold rating on the stock. Citi, viewing the market's negative reaction to QBE's first half results as excessive, has raised its price target to $26.20 with a buy rating. Macquarie has a neutral rating on the stock, while Morgan Stanley rates it as overweight. Inder Singh, QBE Insurance CFO, is confident in the company's profitability and balance sheet for a strong outlook.
The result, I thought was, strong across the board. And, you're always a bit nervous when you've had a strong run up into the results day around share price performance. But, from our perspective, Friday performance was a bit overdone. The market focused a little bit on, the rate of rate increases. So profitability is very healthy now. So across the industry, we're seeing, people being more thoughtful about how much rate increases now going through consumers, because if we're making decent returns, we cannot continue to increase prices to people. So the rate of rate increase in the second quarter was lower, but we're looking at it as, through the year, the business is on a very sustainable footing, profitability is good, the outlook's strong, and, I'm hoping that some of this overreaction unwinds over the next few days.
And what's your outlook, particularly in terms of guidance and your dividend?
Strong. We've reaffirmed all of our metrics. So we reaffirmed our growth target for the year. We reaffirmed our combined ratio target for the year. We've paid out a very healthy dividend at the half year. So very much in line with our practice over the last couple of years. So yeah, we're feeling good about the health of the business.
Let's turn to what is on the corporate calendar tomorrow. We're going to expect results from Life360, 7 Group Holdings, and 7 West Media.